Hi everyone, this is part 2 of chapter 3.7 cash flow. In our previous video, we presented the concept of cash flow and also we talked about the relationship between cash flow and profit, how a business is profitable or solvent or unprofitable or insolvent. We also talked about the working capital, how the working capital cycle works, and its relationship with the cash flow. So now we go to the next part, which is the cash flow forecast. It is possible for a business, either starting a business, even when it is starting up, or a long-running business, it is possible to actually foresee how the cash flow would be like based on current information. This would lead us to the cash flow forecast, which is a document, a financial statement that makes predictions of the cash inflows and outflows over a given period of time. Obviously, this doesn't mean you have to make a cash flow forecast for a year. It usually takes 3 months, 4, 5, 6 months, so you can see in the short or medium term how the cash flow would look like for your business. So I'm showing you right now an example of the cash flow forecast and how it is built. The cash flow forecast has three main sections. The one on the top that shows you the cash inflows, so it's all the money that goes into the cash of your business. In this case, we have the cash sales revenues presented here. In real life, you can find other cash flow forecasts that include other types of inflows that would be coming into your business, not just the sales revenue. This might happen. This is usually divided into several months, 3, 4, or 5 or 6, as I previously said. And then you calculate all the cash inflows to get the total cash inflows of every month. Then you have the cash outflows. This is the second section. The cash outflows show all the regular expenses that you pay with the cash of the business. All your regular expenses usually go here, like water, electricity, raw materials, wages and salaries, advertising if there is any investment, a regular pay for advertisement, the rent, the monthly rent of a specific place or premises. Any loan repayments, for example, would be included. So for every month, you calculate, you find out, and then calculate what the regular expenses would be like that you will be paying to keep the business running, and we calculate that as total cash outflows. So we have these two sections: total cash inflows, total cash outflows. The last section is the part where we make the final calculations to get the net cash flow and the closing balance of every month. So we first get the net cash flow. The net cash flow is a value that we get from total cash inflows minus total cash outflows, and then this is what we get as net cash flow. And then we make a second calculation, which is the opening balance. What is the opening balance? The opening balance is the cash you had when the month started. The net cash flow is the money that is left after a month of operation. So if I'm talking about this month, September exactly, in September you had this money coming in, these 1500s, and then you have this money going out, these 1400s. Both were foreseen. So you calculate, and then you get the net cash flow, which is what is left at the end of these operations, of the money that came in and the money that went out. But when the month started, probably you had some cash from the previous month. So if that is true, then you have cash in your opening balance. So you should include that to consider in your calculation. In this example, we assume that the business is just starting. So because it's just starting, there is no previous cash, so the opening balance is 0. So this is why in this example we are showing the opening balance as 0. Okay, it doesn't have to be like that all the time, but When a business starts, yes, we start with a zero opening balance, of course, because there's no cash when you start. Then we start feeding the cash flow as we go. So again, total cash inflows, total cash outflows, we get the net cash flow, then we get the opening balance, and finally we get the closing balance, which is the final value that we get at the end of that specific month. How do we get that? By adding net cash flow plus the opening balance. In this case, obviously, is because it's 100 plus 0, our closing balance will be 100. Then we go to the next month. Uh, Assuming this is example of a cash flow forecast, we decided, let's say the business decided that sales would increase in 20% every month, for example, and this is how they got these figures. They also assumed that they would increase, again, raw materials also in 20% every month, the cost of raw materials 20% every month, as they are selling more. They also assumed that they would be paying water and electricity, these two services as fixed costs, every 3 months. So this is why they are shown in November. They also assumed or planned to pay for advertising the first 3 months of operations. So it is here. They assume also a pay of wages or salaries for 100 every month. And they also are planning to pay for a loan starting in October every month on a fixed in a fixed figure. So all these are assumptions, obviously after research, after calculations, after proper investigation of how the business would actually work and what the sales would be like and what the cost would be like. So these are all estimations of what the business thinks is going to either get us revenue, get us sales, and also expend. And this is how we get these values, okay? So after we get this, we start making figures. Beginning with the first month, then we go on the second month, we calculate net cash flow. In this case, as you see in the example, cash inflows is less than the cash outflows. Therefore, we're having a negative number. And this is important to take a close look at. The closing balance of the previous month of September turns into the opening balance of October. So this was the money that was left at the end of September. So this is the money we start the month of October with. We are starting with 100 in October. Okay, so we have the sales, we have the expenses. In this case, expenses were higher, outflows were higher than inflows. Then we're having a negative number. So this negative number is added to this 100. So minus 100 plus 100, we are getting 0 cash at the end of the month of October. This 0 cash goes again as 0 when we begin November. We do operations, we have our activities, we sell based on our estimations, we have expenses based on our estimations too. Then we end up discovering we have a loss here. The net cash flow is minus 180. We add it to that 0. Obviously, our closing balance will be negative here. We move it again back to the top in December because our opening balance in December will be the closing of November. So we have here minus 180. Again, we do operations. According to our estimations, the sales revenue finally in December is higher than the total cash outflows. We have some positive in the cash flow, and this would help the business recover. So the closing balance will be positive here, and it goes to January again, being positive. Again, sales increase, costs also increase, but in this case, cash flow will be higher again, and we end up having a closing balance in January of 420. So this is what we have as cash flow forecast. What is this for? It will help us discover that, for example, in November, this business will have problem of cash flow. They will not have enough cash to keep the business running. Actually, something must be done before November, so there will be a higher inflow of money in the business in November to make sure this doesn't happen. We have now discovered that because of this cash flow. We also see that even though there will be a negative net cash flow in November, we can see that later in time, if sales keep on growing, we would recover and get some positive numbers later. So these are some conclusions we can actually get from um, our cash flow forecast. We can also get that this is the percentage we have estimated as sales. We might require higher sales maybe or additional inflows. We might have to consider reducing some costs here to make this cash flow be positive all the time and make sure that we are always having enough cash flow, even though net cash flow or closing balance, to continue working in the following month and not having this specific trouble. So, just to finish, what do we do to improve our cash inflow? For example, talking about these November figures that were negative, how do I increase my cash inflow? Well, I can, for example, promote cash payments. I can insist to my customers that they pay cash instead of plastic or buying by credit. It's more especially by my credit. So I would ask them to pay immediately for those sales. Asking for that, reducing the chance for credits or for paying on credit cards or other ways would obviously mean that I'm not getting. Would obviously mean that some of them might feel uncomfortable and they might not want, and so there's a danger of losing customers. You can also offer discounts or incentives to debtors, so you get, but you might get less revenue, of course, because even though they are paying back sooner, they are paying less. You can increase your product mix. You can increase the variety of products to get to sell more than to increase your sales. But again, producing new things would imply higher costs. You can also find additional sources of finance to give more to increase your cash inflow besides sales. But remember that every single additional source of finance would have their own risks and also limitations. So you have to keep that in mind too. If you want to reduce the cash outflow, you have to negotiate your credit extensions with your suppliers. Obviously, you have to take care of those relationships too because they might not like you paying later for specific trade credits. You can delay the purchase of fixed assets. If you don't actually need them right now, you can keep working with your actual equipment. You might actually delay that purchase so you keep some cash in your business. But remember that you don't have to compromise your efficiency or your assets become obsolete too soon. You can also reduce indirect costs like costs of marketing or any other additional costs you're making every month. Just consider which repercussions they would cause. So you have to make a very wise decision there. Or you can buy cheaper supplies. You can buy to cheaper suppliers. And that would be actually a way to reduce the cost of production. But remember, this would also compromise the quality of your product. What are the benefits and limitations of the cash flow forecast? In benefits, we can mention that it helps to predict future performance of startups. I mean, if you are a beginning business, you can see how well you're going to do before you actually start working, which is amazing. You can also identify periods of insolvency, like the one we saw in example, like we saw in November. There will be a period of insolvency. So seeing that beforehand will help you plan ahead. You can monitor changes in cash flow before investments, cost reductions, or anything. So you can make changes in that very same chart and see what would happen in your cash flow. So you can monitor what happens. Even if you have a cash flow forecast and then start working, you can see how well it works. Limitations, however, is that this document doesn't consider unexpected changes in the economy. If something happens in the country or city or region you're working on that would affect your economy, that's not foreseen in the cash flow forecast. We're looking at the best conditions in the cash flow forecast. It doesn't see either unexpected changes in employees or equipment performance. If your employees go on strike or you lose employees or your equipment stops working properly, that will be also a problem. And obviously, it doesn't either consider behaviors competition. It doesn't look at the competition. It just looks at you in the best possible conditions. So even though it's an amazing document to forecast, to foresee how your money goes in and out, and to keep the business running in the short or medium term, it doesn't see everything perfectly. So that's it for cash flow, and this is it for this video. Thank you and bye.